Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with the weekly news. And of course, the only man that brings us the news is Nick Bendel. Hello, Mr. Nick.
Hello, Mr. Owen. Great to join you.
Yes, good to have you back for after another week. Hopefully there's lots of interesting news stories that's happened in the past week. But what's been happening in your week?
Oh, I had a really good week. A lot of enjoyable things. The highlight, I think, was SFG, the mortgage aggregator, put
Oh,
on a
yes.
really good commercial finance summit in Sydney. I went along to that,
Hmm.
enjoyed the sessions, pressed the flesh, chatted with quite a few brokers, some existing clients, some people who didn't know that they were about to become clients if
Cool.
I get my hooks into them. It was a really
Yeah,
good event. SFG, they always host fantastic events.
fantastic. And you got invited along to that, or you just sort of stalked and turned up?
Well, I got invited along by me. Does that count?
Oh, okay. All right. So yeah, so you just stalked and turned up and pushed your way in.
Well, I did have a ticket.
Oh, okay. All right. Cool. Well, that's glad to hear that you just weren't sort of lurking around the edges and managed to get yourself in. But glad
I
to hear.
I do like to go to these broker conferences. For those who don't know, my business, Hunter and Scribe, we write
Yes.
content for finance professionals throughout Australia. We work with dozens of brokers. Brokers are my people. So if there is a mortgage conference on somewhere, I will be there, whether I have to buy a ticket or just sneak in through the air conditioning system.
Fantastic. All right. Well, there's anyone out there who's running a mortgage broking conference, Mr. Nick is the one to invite, obviously.
Yeah, and I don't eat much food. I do drink quite a bit of tea, but tea bags are pretty cheap. So I'm a pretty cheap date.
Oh, fantastic. Good to hear, Nick. Well, yeah, been busy with us in the past week as well. We've been getting lots of properties leased. We've had a
Mm.
ton of properties on the market in the past few weeks. So the past week has been good in terms of getting some off the books and getting leased for our clients. Got to keep those clients happy. And of course, it's end of month run today, and so going to make everyone happier by sending them some money. So yeah, it's been a busy week for us as well. But Nick, we're here to hear about the news. What's happening in the news this past week?
Well, let's begin with the story that was always going to be one of the major themes of this year. Inflation holds steady. Annual headline inflation remained flat in April at 2.4%, according to the Australian Bureau of Statistics, the third straight month of no change. However, the Reserve Bank's preferred measure of inflation, the trim mean, rose from 2.7 to 2.8%. While that's still within the RBA's target band of 2 to 3%, it does show there are still inflationary pressures bubbling in some corners of the economy. Okay, Owen, when the RBA made its first rate cut of the year in February, some people were concerned it might lead to higher inflation, but the inflation rate has not budged in that time. It was 2.4% in February and was still 2.4% in April. So does that vindicate the RBA's decision?
Well, yes. Does it vindicate it? Well, their preferred method of measuring inflation is still the trimmed mean. And that's what all the people in the know, including you and I, were looking at and thinking, has the RBA sort of, yeah, jumped the gun a bit? Because they're saying that the trim mean inflation is still a little on the high side and not necessarily showing it's coming down. And this is just proving the point. So, yeah, have they really jumped the gun with these first two rate cuts?
Hmm. Well, I guess we're going to find out soon. It's going to take another couple of months before the May rate cut starts showing up in the inflation figures. Are you worried that the combination of the February rate cut and the May rate cut are going to lead to higher inflation?
Well, that is the concern. I mean, there's other factors in the economy, and that the RBA is taking into account that could have a deflationary effect, and in terms of slowing the economy. So that's one of the factors that they've taken into account with cutting rates. But yeah, we still haven't seen this. Inflation monster getting hit on the head well and truly. So yes, that's the concern here when we look at the inflation figures by itself.
Okay, well, let me follow up on that. So the RBA has consistently said that it doesn't just want inflation to be within the 2 to 3% target range. It wants it to stay there on a sustainable basis. Headline
Mm.
inflation has now been within the target range for 9 consecutive months, and trim mean inflation rate has been within the target band for 4 consecutive months. So I'm wondering, Owen, does that meet the definition of sustainable?
Well, it's a good indication, but yeah, it's still on the high side. We've seen that now the trim mean inflation, rise slightly, and yeah, there could be short-term factors there, so it might not be anything to get too excited over. But yeah, the sense is that yeah, it's very much better than where it was, but it's still not quite. Where we would like it to be.
So I guess part of the concern with uh, is rates going down? If rates are lower, are people going to spend the extra money and therefore stimulate the economy and therefore put upward pressure on inflation? I think we might have some further news on that a little bit later on. So
Oh, okay. All right.
let's keep that to one side for the moment and move on to our next story. Borrowers in cautious mood. NAB Executive General Manager Denton Pugh said the vast majority of borrowers responded to the RBA's first cash rate reduction in February by saving rather than spending their rate cuts. Pugh told News Corp, when NAB cut its variable rate back in February, we saw activity increase. For mortgage holders, some chose to reduce their monthly repayments to free up cash, but more than 95% of NAB customers have kept their repayments at the same level to pay down their home loan quicker and save more in the long term. 95%, Owen. Are you surprised that so many borrowers saved rather than spent their February rate cut?
Um, well, it's something that the banks have started doing of recent years, where they don't, yeah, they'll pass on the interest rate cuts, but they won't adjust the repayments. So I think NAB is yeah, making up some figures here to get themselves in the news, because most borrowers probably don't even realize that they have to contact the bank to be able to make that change themselves. So um, if you're with NAB and you didn't know that your repayments had actually had not reduced, even though your interest rate has reduced, but your repayments haven't reduced, then yeah, just a reminder, reach out to them and ask for the repayments to be reduced if you're in a spot of bother from a cash flow point of view.
Okay, well, I was going to ask.
It, yeah.
I was going to ask whether you expect most borrowers to save the May rate cut as well. It sounds like from what you're saying, they probably would, because that would be the default option with their lender, and most people wouldn't realize that they needed to contact their lender to reduce their repayments.
Yes, it's not like they get a call from their friendly banker and say, "Oh, would you like to keep on paying the same amount every month, or do you want us to actually reduce your monthly commitment?" It's like, no, it's something that they have to call up, contact their bank, and actually ask for it.
I'm just wondering, why would lenders do this? Because the longer a loan lasts for, the more money they make. Why would they want their customers to pay off their mortgage sooner?
Because it's better for them from it's a more conservative option to be able to help clients pay off their home loans sooner. And even though it's in little bits, it's actually good for the balance sheet to be able to make sure that they've got more equity as security on that property that they've got. And yeah, it's it's in the bank's interest to make sure that people are paying off their loans sooner. Yes, it probably meets some of their APRA regulations as well.
Speaking of loan repayments, even when the cash rate peaked at 4.35% in November 2023, mortgage arrears stayed at low levels, despite the fact many people were doing it tough. Owen, why do you think the vast majority of borrowers have remained resilient in the face of these higher rates?
Because our economy, from a job point of view, has performed still fairly well. People have been, it's not like we've been in recession where companies are laying off thousands of people at a time. And so our employment level has remained fairly healthy. So it's so when you take that into account, there's people will always cut back on other things, such as entertainment and takeaway food, going out, that type of thing, before they stop paying their mortgage. And at the same time, we've seen property prices continue to grow on average over this period of time as well. So if people do get into trouble and they need to sell, they've still got that equity in the property where they can still sell, pay off the mortgage, and hopefully have a little bit left over for themselves.
Let's move on to our final story today, the rise and rise of rent vesting. Borrowers are adapting to a challenging housing market by increasingly turning to rent vesting, according to a riser buyers agency director, Adil Rizvi. Rizvi told Real Estate Business magazine that rent vesting was increasingly being seen as a financial strategy, not a fallback option. First home buyers are starting to see property not just as a place to live, but as a way to build long-term wealth, he said. First home buyers today have more information at their fingertips than ever before. They know which areas offer strong rental demand and capital growth, even if they are outside their own city. It's no longer a guessing game. Rizvi said that people who are paying $800 to $900 per week in rent in some Sydney suburbs would be looking at weekly repayments of $1,700 or more for similar properties. Instead of compromising on location, they choose to rent where they want to live and buy an investment property elsewhere, he said. Oh, and have you noticed an increase in rent vesting among your property management clients?
Oh, absolutely. Absolutely. And also good to see one of our business partners with a deal making making it into one of our industry magazines. And so shout out to a deal there. But yes, rent vesting is very much something that is on the up and coming, because and increasing all the time, because especially with young first home buyers / investors, they're needing to get into the market, and where they need to live to be able to work, it's not affordable for them to buy, but they're still wanting to get into the property market. And the best way of doing that from a cash flow point of view is to rent where they want to live or need to live, and then buy where they can afford. And quite often, it's much cheaper from a cash flow perspective to be able to buy somewhere else for investment, and using the higher rental values or the better rent return based on a different type of investment or different type of property that's better for investment and continue to rent where they need to live.
Adil Rizvi made an interesting point. He says first home buyers have more access to data than previous generations of first home buyers, which makes them both more willing and more able to make their first home an investment property. Given that the amount of property data is only going to increase, do you think, Owen, that rent vesting will become even more popular in the years ahead?
Yes, because simply it's the smarter choice. When you break down the numbers from a cash flow point of view, the only reason you would buy a property to live in would be for lifestyle reasons. It's because you might have a family and you want that security, and you want to make sure that you're always going to be in that school catchment zone. So you need to buy there and make sure that you can always stay there. And so it's all those sort of long-term sort of family and lifestyle reasons that would purely from a numbers point of view and cash flow point of view, yeah, it would be the only reason why you would end up buying to live in.
Well, funny you should mention that. I know quite a few buyers agents who rent vest because they say it doesn't make financial sense to buy an owner-occupied home, and you've kind of explained why. Do you think that will ever become a mainstream view? In other words, can you see the day when Australians become less obsessed with home ownership?
We are a country of real estate lovers, so I don't think we'll lose the real estate bug, but it's probably going to be another generation or so before we get to the point of not being obsessed with buying where you want to live.
Well, that is the end of our chat today, Owen, or Mr. Owen, as I apparently should call you. Really enjoyed the chat. Now, I'm speaking to you from my usual Sydney home office, but we might have a different location for next week's chat.
Yes, it sounds like it. You might be on the other side of the world, I believe.
I might be, but we'll have to wait and see.
Yes. Well, we will have a good trip and flight. Don't trip onto the flight, but I hope you have a good flight. And we will see you next week with the weekly news. Thank you, Nick.